Hey guys, welcome back to the channel. In this video, I want to go through Alphabet's earnings, I want to go through Amazon's earnings, and Microsoft's earnings. So all three reported last week. Meta also reported last week, but I wrote an in-depth article on that on my Substack, so I'm not going to cover that here. So with that, let's get started. If you like this content, please like and subscribe. And so I've pulled up Google's earnings report here, presentation. So let's go through that and see what the highlights were. So here we had Q1 year-over-year growth in search and other revenue segment of 19%, which is really good. They had Q1 year-over-year cloud revenue growth of 63%, which also has a $460 billion backlog. And so that's huge because that will allow them to fund any AI CapEx going forward into the future, a backlog of future customer commitment. So that's very important to continue funding their AI ambitions. And then Gemini Enterprise paid MAUs, monthly active users, plus 40% quarter over quarter. You have 16 billion plus tokens per minute, which is positive 60% quarter over quarter. And they have one of the leading models in Gemini, the AI models in Gemini. So that's another factor that's working for them. And that's what this speaks to. They have 350 million paid subscriptions across Google One, YouTube, and other. And then they have 500,000 plus Waymo fully autonomous rides per week. So that's been scaling nicely and that will pay off at some point. But they're still trying to work on car creation economics for that. So really strong earnings highlights just from this first slide. And if we go into their actual income statement here, you can see that their revenues for Q1 26 were 109,896 million. There's a 22% year-over-year growth from quarter to quarter. The cost of those revenues increased only 14%, so that's amazing. Research and development, 4 billion approximately, so 26% increase. Sales and marketing, very little, 23%, but nominally very little. And then G&A also nominally very little at 21% increase. So they're keeping this relatively in check, and we have to keep monitoring these numbers, but they're getting nice revenue growth year over year on the quarter. Total costs and expenses went up 18%, so that's lower than the 22%. Income from operations, 30% increase at 39,696 million. And then you have other income, so that went up 237%. Income before income taxes went up 85%. Provision for income taxes went up 105%. So huge increases in income from operations segments here. Net income therefore came in at 81% higher than the quarter last year. Diluted EPS came in at $5.11, which is 82% year over year. Their main revenues comes from their Google Search and Other segment, which represents approximately 60.399 billion of that, which is 19%, like I said. Then you have 9.883 billion coming from YouTube ads, which is growing nicely at 11% year over year. Then you have Google Network, 6.971 billion, which went down actually year over year. And then you have subscriptions, platforms, and devices at 12.384 billion. 19% year over year. So altogether, that's year over year growth of 16% on all those different segments. And operating margin increased about 3 basis points here year over year. Now, cloud revenues, also a huge increase here in plus 63% year over year. And then operating margins also huge increase, 32.9% and versus 17.8% last quarter year over year. Capital expenditures, obviously all mega cap tech have been increasing capital expenditures. You can see that they've increased it to 107% now year over year. And I don't see that stopping because clearly Alphabet and probably Meta are the best positioned because of their advertising to take the capex that they spend and actually get a nice return, immediate return from it. So those two companies are the ones I'm looking at to see if they're generating more revenue, more and more revenue as they spend more and more on AI capex. And here you can see this is just going up and to the right. But this could be a problem if the revenues start to decline or don't show as much revenue growth in the future while they increase their capex. And I think that's the concern with Meta right now, which why they dropped. But here, Google is a hyperscaler. It has that cloud business that's growing crazy. They can literally sell that compute to customers and consumers of the AI spend. So that's why they got rewarded while Meta got crushed. Just got to keep an eye on this and make sure that they're not going into too much debt with the capital expenditure piece. Trailing 12-month free cash flow is coming in at 27% for the net cash provided by operating activities, 107% for the capex basically, which is property and equipment, then negative 47% year over year because of that capex, and negative 14% year over year for the 12-month free cash flow. So all in all, Google had an amazing quarter. I think they had the best financials that I saw, best report that I saw of the mega cap names, and that's why they went up roughly 10% or higher after earnings. What I would keep looking at is their capex, how much they're continuing to spend, if they're going into more debt for it, and those free cash flow numbers should need to come back up if they're to be valued at any significant higher valuation than as of now. Right now, I did do a Substack article on Google and analyzing their stock and their fair value. It's lower than the current price because of all of this AI capex and also the insane move up in the stock price. They're sitting at 4.8 trillion or something around that, and they'll probably reach 5 trillion and overtake Nvidia. That's my belief, just because they're so operationally efficient and good at turning that AI capex into revenue in all of their segments: YouTube, cloud, platform, subscriptions, search, which is the big thing, and advertising. So I think they are well positioned to grow with the AI capex spend, but I would see that they are like fairly valued to a little bit overvalued at the current time. Okay, so let's move on to Amazon, and here's their financial presentation. So here, their net sales went up, or revenue went up 17% year over year, up 15% foreign exchange adjusted. The net sales came in geographically 104.143 billion, 57% from North America. International came in at 39.789 billion, 22%. And AWS came in at 37.587 billion, which is 21%. They had most of the money just coming in from North America, and then it kind of split off evenly between international and AWS. Now, net sales trailing 12-month, you can see it's going up and to the right slowly, but still going up. 14% year over year, 13% foreign exchange adjusted. Then operating income is up 30% year over year. So they're comparing it to Q1 2025, Q 2026, so 18.405 billion versus 23.852 billion, which is nice. Then 12 months is also going up and to the right, 19% year over year. Net income also up and to the right. They had 77% year over year growth, which is really amazing. And that's why they're getting rewarded too right now, in my opinion. They're increasing their net income like this, which means that they are being operationally efficient and savvy with how they're running their business. Net income trailing 12-month is up 38% also. So segment results, net sales here up 12% year over year in North America. Operating income up 42% year over year. Segment results international up 19% year over year, and operating income up 40% year over year. And then AWS is up 28% year over year. So this is the AWS growth, revenue growth number, 28%. It's not as high as Google Cloud. And Google Cloud coming in at 63%, AWS coming in at 28%. I mean, it is the biggest one for now. And it produced $37.587 billion. So it's a sizable portion of their revenues, total revenues, but the growth rates are slower than GCP. Operating income for AWS, 23% year over year, 26% foreign exchange adjusted. Free cash flow down and to the right. So here you can see that they just keep spending on CapEx. Amazon is known to spend a lot on CapEx and basically reinvest all of their free cash into their business again, just to grow out the business laterally, and then build up the revenue from each one of those businesses. So it's down 95% year over year, but you wouldn't even be able to tell this based on how the stock price is moving up, even though the free cash flows are declining. And you can see that in Google as well, and I'm sure we'll see that in Microsoft as well if they are still continuing their AI CapEx spend. So they have $1.232 billion in free cash flow. It's still positive, but barely, and it might even go negative next quarter or two. Shares, I've said this in previous videos about Amazon. They just maintain the status quo with the share count. They're just efficiently managing dilution. They even say it. Long-term goal is just to efficiently manage dilution. So can't really expect much of any type of share reduction in this company. So if you buy Amazon, it's really just for the growth of their businesses, because you know that they're going to return all of that capital back into their business. They don't issue a dividend. They have huge AI CapEx, or CapEx in general. They're an asset-heavy business with all their data centers and all of the other stuff that they have, logistics. So if you buy this company, you solely believe in Amazon's ability to use those businesses and leverage growth from them, which they are very good at. So that's why you would buy this shares, and that's why stock is getting rewarded at the current time. So when I was looking at this, it was around 200, and now it's closer to 273. I believe it's making 52-week highs. So that's why you would buy this. Okay, so let's move on to Microsoft, which is the last one I want to look at here. I pulled up their earnings presentation. So here they have both GAAP and non-GAAP results. Revenue is up 17%, up 15% currency constant, up 15% constant currency basis, driven by intelligent cloud and productivity and business processes. And they're saying that cost of revenue increased 19%, up 18% constant currency basis, driven by growth in Microsoft Cloud. Here we're seeing that their revenue increased 17%, but their cost of revenue increased 19%. So that's not great. Gross margin increased 16%, up 14% constant currency with growth across all segments. That's good. Gross margin percentage decreased slightly, driven by continued investments in AI infrastructure and growing AI product usage, partially offset by efficiency gains across the Microsoft Cloud and sales mix shift to higher margin businesses. Operating expenses were $17 billion, up 5%, 4% constant currency basis, driven by R&D investments in compute capacity and AI talent, those are just AI CapEx, as well as impairment charges in our gaming business. So that gaming business needs to be watched. Operating income grew 21%, that's great, up 19% constant currency basis. Other income and expense was $10 billion, driven by a gain as a result of the OpenAI recapitalization. On a non-GAAP basis, results were $0, as interest income was offset by interest expense. Effective tax rate was 20% and 19% on a non-GAAP basis. Diluted earnings per share was $5.16, up 60% year over year, and non-GAAP was $4.14. Not bad results, but the cost of revenue increasing at a greater clip than the revenue is not great, and that's not what you want to see. And you can see that the personal computing area is negative 3% here, which is not good. Intelligent cloud, that's growing at 29%. So comparing this to AWS and GCP, that means that we're seeing Google in the first place, then Microsoft, and then Amazon. And that to some extent makes sense because Amazon has the largest one. So here they returned $12.7 billion to shareholders. So they are returning money back to shareholders with dividends, $6.8 billion in dividends and $6 billion in share repurchases. Split that capital return back to shareholders. Capital expenditures, and this is very important, including assets acquired under finance leases, were $37.5 billion, up 66% to support customer demand for our cloud and AI offerings. Roughly 2/3 of the capital expenditures were for short-lived assets, primarily GPUs and CPUs. supporting Azure, and growing first-party applications and AI solutions. The remainder was for long-lived assets, which support monetization over the next 15-year period and beyond. So cash paid was about $30 billion, up 89%, lower than the capital expenditures primarily due to finance lease. Cash flow was $35.8 billion, up 60%, driven by strong cloud billings and collections. So that's good because in some of the other mega cap tech names, their cash flow is decreasing significantly, but Microsoft seems to be holding on to a nice level of free cash flow at least, and they're attributing that to strong cloud. Free cash flow was not $5.9 billion, down 9%, reflecting higher capital expenditures and to support our cloud and AI offerings. So if you looked at Google's and Amazon's, the free cash flow is slightly higher here at Microsoft, but it's still down 9% because of the increase in AI capex, which all of them are doing. Microsoft Cloud revenue was $51.5 billion, up 26%. Commercial bookings increased 230%, driven by Azure commitments from OpenAI and Anthropic. Their RPO, remaining performance obligations, of $625 billion increased 110%, with a weighted average duration of approximately 2.5 years. Really nice. And roughly 45% of the commercial RPO balance is driven by commitments from OpenAI. So, that could be a problem based on what they can actually afford and how much money the OpenAI actually makes to, honor these commitments. That's not what you want to see. You want to see it from a more diverse range of customers. Here you can see their productivity and business processes grew 16%. And driven by the Microsoft 365 Commercial Cloud. Cost of revenues grew 10%, gross margin dollars grew 17%, operating expenses grew 6%, and operating income grew 22%. Their Commercial Cloud revenue grew 17%, and their commercial products revenue grew 13%. Microsoft 365 Consumer Cloud revenue grew 9%, LinkedIn grew 11% revenue, that's pretty good, and Dynamics 365 grew 19%. Then you have Intelligent Cloud, which is the Azure and AI, 29%, driven by Azure, and cost of revenue grew 44%. So that's not good. This is growing much faster than the revenues from this segment. Gross margin dollars grew 20%, operating expenses grew 3%, and operating income grew 28%. So Azure and other cloud services revenue grew 39%. Enterprise and partner services revenue grew 8%. Personal computing, this is a minor segment for them, but revenues declined 3% here. Okay, so that does it for Microsoft, and Microsoft's earnings were okay, but it's not like groundbreaking. They are increasing capex just like all the big cap tech names. They are reporting nice numbers for their cloud, even though it's not any close to what GCP is. You have to keep an eye on the RPO obligations from OpenAI because those are 45% of them. Of the total RPO. Okay guys, that's it for this video. If you like this content, please like and subscribe, and I'll see you in the next one.